I'm at REIT World 2012 in San Diego, and joining me today is Berlin East, CEO of American Assets Investment Management. Thanks for joining us today.
Great to be here, Krista.
Let me ask you, should investors feel confident about the REIT sector as a whole going forward?
Well, investors in REITs have been well rewarded over a long period of time. REITs have outperformed every other asset class, be it equities or debt, a variety of other things, gold and oil, for 30, 20, 10, 5, 3, and 1 year periods. The chart's always the same. We believe that most institutional and retail investors are best served seeking an allocation in real estate through REITs, and we run a REIT fund, largely because REITs have transparency, liquidity, and governance. And those three things are incredibly important, particularly in wake of what's happening in a regulatory sense and what happened in the downfall of the last cycle. And so we think yes is the short answer. REITs are a fantastic way for your typical investor, institutional or retail, to get exposure to real estate.
If you had to sum up in one sentence what we've seen in the REIT market in 2012 so far, what would that be? And what do you predict will be the main story in 2013?
We think we're in a long-term cyclical recovery in commercial real estate values pretty much everywhere in the U.S., regardless of property type or location. It varies from place to place and from property type to property type, but generally speaking, we've been in a good year. I think REITs are up something like 11 or 12% as we speak right now. Our fund is up about 17, 18%, so we've had a very good year. I would expect that next year would look a lot like this year. We had no change in government recently. We have the same president, the same Senate, the same House. They still need to get over the fiscal cliff, but the dynamics that are in place today, which are modest-ish sort of growth and stagnant job creation, let's call it 1 to 2% GNP, we would think that would continue. And so, we're interested in a little bit more defensive REITs, so things like healthcare and lab space and data centers and cell phone towers and things like that, where there's not a need for the economy to be growing very quickly to fuel FFO growth like there would be maybe in some other areas. That's where we're positioned, and that's what I think we're looking for next year. Although the government might surprise us and do the right thing and solve the fiscal cliff in a more aggressive way, and maybe things will be better than this. But for now, we're sort of thinking kind of a lot more of the same 2% GNP growth.
Aside from jobs, what do you think are some of the economic indicators that will particularly impact REITs that we should be having our eye on?
The biggest thing we think that's an outlier is inflation. We're at the end of a 30-year bull market in bonds. When I entered the business in 1982, there weren't many. There's some of the people around still that were back then, like Bob and Marty, guys like that. Interest rates were 14%. They're now effectively zero, and we've had this tailwind. And so if you were to get a period of time where you'd have creeping inflation, and we certainly have expansionary fiscal and monetary policy right now, along with higher rates, that would be something that investors need to think about. Real estate typically, particularly well-leased real estate, serves as a pretty good inflation hedge. And so we think that inflation would be beneficial to our space. Interest rates, not so much, but inflation, yes. And so we think that's the biggest outlier that investors should be sensitive to. We should be it's not here now, but they should be thinking that perhaps 18, 24 months from now, you see a creeping rate of inflation and interest rates are going back up as opposed to down.
Thanks so much for joining us today, Berlin.
Thank you.
I'm Carissa Chappelle for REIT.com.